Cryptocurrencies have rapidly emerged as one of the most discussed topics in the financial world over the past decade. What started as a niche interest for tech enthusiasts and libertarians has now grown into a multi-billion-dollar industry. The rise of Bitcoin, Ethereum, and other digital currencies has captured the attention of investors, financial institutions, and even governments. However, while the potential rewards of cryptocurrency investment can be enticing, it is essential to understand the risks and challenges that come with this relatively new asset class. In this extensive analysis, we will explore whether investing in cryptocurrencies is a good idea, addressing both the potential benefits and significant risks involved. Cryptocurrencies are digital or virtual currencies that use cryptography for security, making them nearly impossible to counterfeit or double spend. The most well-known cryptocurrency, Bitcoin, was created in 2009 by an anonymous entity known as Satoshi Nakamoto. Bitcoin was designed to be a decentralized currency, free from the control of any government or central bank. Since then, thousands of other cryptocurrencies have emerged, each with its own unique features and use cases. The rise of blockchain technology, the underlying framework for cryptocurrencies, has been another significant factor contributing to the popularity of digital currencies. Blockchain offers a decentralized, transparent, and secure way to conduct transactions, which has attracted interest from industries ranging from finance to supply chain management, healthcare, and more. The potential benefits of investing in cryptocurrencies. 1. High potential returns. The primary allure of cryptocurrencies for many investors is their potential for significant returns. Bitcoin, for example, has seen its price increase from mere cents in the early days of its existence to over $60,000 at its peak in 2021. Other cryptocurrencies, such as Ethereum, Solana, and Cardano, have also experienced impressive growth. Early investors in these coins have seen extraordinary returns, which has led many to believe that cryptocurrencies could be the investment opportunity of a lifetime. In the world of traditional finance, high returns often come with high risk, and cryptocurrencies are no exception. The volatility of these assets is what makes them both potentially lucrative and risky. However, for investors with a high-risk tolerance, the possibility of striking it rich with the right coin is a compelling reason to consider cryptocurrency as an investment. One of the key selling points of cryptocurrencies is their decentralization. Unlike traditional fiat currencies, which are controlled by governments and central banks, cryptocurrencies operate on decentralized networks. This means that no single entity controls the issuance or movement of cryptocurrency. For some investors, this represents a form of financial freedom and independence from the traditional financial system, especially in regions where inflation or political instability has eroded the value of local currencies. Cryptocurrency investors may find the ability to transact without intermediaries, such as banks or governments, appealing. The decentralized nature of cryptocurrencies offers the promise of censorship-resistant transactions, particularly in countries with oppressive governments or restrictive financial systems. For investors looking to diversify their portfolios, cryptocurrencies present a unique opportunity. Traditionally, portfolios have been built around stocks, bonds, real estate, and other traditional assets. Cryptocurrencies, however, are a new asset class that behaves differently from traditional investments. In theory, the inclusion of cryptocurrencies in a diversified portfolio could reduce overall risk and potentially enhance returns, as their price movements do not always correlate with those of traditional assets. Additionally, as cryptocurrencies are increasingly adopted by businesses and financial institutions, their use cases and acceptance may expand, offering further growth potential. Companies like Tesla, PayPal, and Square have begun to accept cryptocurrencies, signaling their growing integration into the mainstream economy. Some investors view cryptocurrencies, particularly Bitcoin, as a hedge against inflation. Bitcoin's supply is capped at 21 million coins, which means that no more will be created once this limit is reached. This fixed supply stands in contrast to fiat currencies, which can be printed by central banks without limit. In times of inflation, when the value of fiat currencies is eroded, Bitcoin's limited supply could theoretically preserve its value and even appreciate. Other cryptocurrencies, like Ethereum, are also considered by some to offer inflation protection, although their monetary policies differ from Bitcoin's. As inflation concerns continue to rise globally, digital assets could be seen as a store of value that preserves purchasing power over time. The risks of investing in cryptocurrencies. 1. Extreme volatility. While the potential for high returns is a significant attraction, cryptocurrencies are notoriously volatile. Prices can fluctuate dramatically over short periods, making them a risky investment for those who cannot tolerate such fluctuations. For example, Bitcoin has experienced several boom and bust cycles throughout its history, with its value skyrocketing one year and plummeting the next. This extreme volatility can be especially concerning for new investors who may not fully understand the inherent risks of the market. Sudden drops in the value of a cryptocurrency can lead to substantial losses, leaving many investors feeling disillusioned and hesitant to return to the market. Regulatory uncertainty. The regulatory environment surrounding cryptocurrencies remains highly uncertain. While some countries, like El Salvador, have embraced Bitcoin as legal tender, others have banned or heavily regulated cryptocurrency trading. The lack of a clear regulatory framework creates an environment of risk, as governments can change their stance on cryptocurrencies at any time. In particular, concerns over money laundering, tax evasion, and financial crimes have led some governments to consider strict regulation of cryptocurrency exchanges and transactions. If cryptocurrencies were to face severe regulatory crackdowns, their value could plummet, leaving investors exposed to significant losses. Number 3. Security risks and hacking. Although blockchain technology itself is highly secure, the broader cryptocurrency ecosystem is not immune to cyber attacks. Cryptocurrency exchanges and wallets have been targeted by hackers, leading to the loss of billions of dollars worth of digital assets. In 2020 alone, cryptocurrency thefts totaled over $1.9 billion. For investors, the risk of losing their investment due to hacking, fraud, or theft is a serious concern. While there are steps that investors can take to protect their holdings, such as using hardware wallets and ensuring strong security practices, the possibility of loss due to hacking remains a significant risk. Number 4. Lack of consumer protections. Unlike traditional investments, cryptocurrencies are not insured or protected by governments or financial institutions. In the event of fraud, hacking, or loss of funds, there is typically no recourse for the investor. This lack of consumer protection makes cryptocurrency investments riskier than more traditional investment vehicles like stocks or bonds, which are regulated by authorities and protected by insurance programs in some cases. Additionally, the decentralized nature of cryptocurrencies means that if an investor loses access to their private keys, which are necessary to access their funds, there is no way to recover the lost assets. This poses a significant challenge, particularly for less experienced investors. The environmental impact of cryptocurrency mining, particularly Bitcoin, has also raised concerns. Bitcoin mining requires significant computational power, which in turn consumes large amounts of energy. In some regions, this energy is derived from fossil fuels, contributing to greenhouse gas emissions and environmental degradation. As environmental sustainability becomes an increasingly important issue for investors and regulators, the energy consumption of cryptocurrency mining could lead to regulatory scrutiny or public backlash, affecting the long-term viability of certain cryptocurrencies. The answer to whether investing in cryptocurrencies is a good idea depends largely on your individual financial goals, risk tolerance, and level of understanding of the market. Cryptocurrencies offer high growth potential and the possibility of significant returns, but they also come with substantial risks, including volatility, regulatory uncertainty, and security concerns. For those with a high-risk appetite, a well-researched approach to cryptocurrency investing could prove to be rewarding. However, it is crucial to approach the market with caution, diversify your investments, and only invest what you are willing to lose. Investing in cryptocurrencies can be an exciting opportunity, but it is not without its challenges. As with any investment, it is essential to conduct thorough research. Stay informed about market trends and regulatory developments, and consult with financial advisors before making decisions. Ultimately, Whether or not cryptocurrencies are a good investment depends on your personal circumstances and your ability to manage the risks involved.